Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
Hello.
Yep. Right now, we are recording this episode and it is late August. And by the time you hear this, there's a decent chance the Federal Reserve has cut the federal funds rate, which is the overnight lending rate between banks. It's kind of been talked about for a long time, all year, basically. Like, when are they going to cut rates? When are they going to cut rates? And it seems like it's actually going to happen pretty soon, regardless of whether they cut in September or not. Most prognosticators are predicting, and the market is pricing in multiple interest rate cuts before year end. And I think even at the beginning of 2024, like the market was pricing in multiple rate cuts this year, and it just hasn't happened yet. It's taken quite a bit longer than we expected. So how many cuts and how much the Fed reduces rates is up for debate, but it appears that things are headed in that direction. And I think you can see that in the news, you can see that in mortgage interest rates. A lot of things are already starting to kind of pencil that in. Inflation has cooled to below 3%. That's a big driver of how and when the Federal Reserve decides to change rates. And that's as of August. And there's no reason, in most economists' opinion, that the federal funds rate should be more than 2% higher than the inflation rate, which it is right now. It's unlikely that we'll see any sort of zero interest rate environments like we experienced during the 2010s and during COVID, unless another catastrophe strikes of some kind. But it's probable that we'll have lower interest rates in the coming months and years. So we're going to start to see that come down a little bit. And what does that mean for us? We're going to talk a little bit about that today.
What does it mean for us? And yeah, I think I just looked it up. The Fed funds meeting is September 17th. So you might, depending on how quickly you listen to these, maybe you'll listen to it before that meeting. Um, but yeah, it's highly anticipated the Fed will cut rates. But yeah, what does that mean for us? So kind of federal funds rate 101 here. The Fed controls the federal funds rate, which is the overnight lending rate between banks. They all collectively, there's a bunch of the banks participate and people from the various city feds, and they all collectively agree, here's what we're going to charge each other to lend each other money. You could argue it's maybe collusion, but not really, because it's just they're helping each other out. It's not affecting the customers adversely. But yeah, so they agree on the overnight lending rate between banks. That's all they're controlling. They don't control treasury rates, they don't control mortgages, they don't control auto loans, they don't control your bank interest rate, what they pay you on your high yield savings account. That being said, there is a little bit of a trickle down effect, because if banks can borrow money from each other for lower rates, then they don't have to charge as much to lend money to you and I for car loans, auto loans, things like that. It also means they're probably not going to pay as much interest to bank depositors. So that's one way that banks, really the main way banks run their operations. They collect deposits from you and I in checking and savings accounts. They have to keep some of that in a vault. The rest of it they can lend out for car loans, home loans, etc., business loans. But it's a competitive environment. There's lots of banks out there. They want customers, they want to stay in business, and they want to maximize their profits while still remaining competitive, because if they try to charge too much, people are going to go borrow from another institution. If they don't offer a high enough rate on their high interest savings account, again, people are going to move their money to another institution. So it's a competitive free market. But again, it's kind of all intertwined to some degree. There's a component of the cost, there's a component of supply and demand. But important to note that. So some people might think, oh, rates are coming down, that means I can refinance my mortgage. Not so fast. Maybe not. It'll probably have a delayed effect, if it has any effect at all. And we'll talk about it in a second, because some could argue that that's already being priced into current mortgage rates. But generally the Fed changes interest rates based on economic data. So they'll use it as a tool. They'll lower rates to provide stimulus for the economy. It's cheaper to borrow money, which means it's easier for businesses to borrow money and then invest in their business and hire people and sell products and services. And that's generally viewed as a good thing. But if you have a strong economy and low interest rates, there's too much free money out there and things can get too strong. And that's where you run into the inflation issue, like we experienced a few years back. And the Fed needs to have some leverage to play with interest rates a little bit. Like when interest rates are zero, you can't go any further down unless you go to a negative rate environment like some countries have done. But they want to have some level of interest that's a baseline interest rate in the economy so that if we experience another recession or pandemic or insert catastrophe here, they have the ability to drop rates, which will help stimulate the economy and get us back on track quickly. So I think long term, this is probably a good thing that rates have come up, even though it came up faster than most people would like. Still, historically, we're at a pretty modest interest rate environment right now. One could argue below average if you look at the historical data. Um, but uh, but yeah, having some interest, I think, is healthy for the overall economy. And then, the Fed raises interest rates to help uh, reduce the ability for companies and people to borrow freely and help control inflation and cool off the economy a little bit. So the other tool the Fed uses is they can buy and sell treasuries. So if they want to inject cash into the economy, they'll buy treasuries. So people have treasuries, Fed buys them up in exchange for dollars. If they want to remove money from circulation, they'll sell treasuries. They sell us bonds. We give them cash, less cash to go around for other things, but we hold bonds that are collecting some interest. So little tools there that are part of the overall monetary policy that the Fed employs.
Yeah, it's all very complicated, all this macroeconomic stuff, but there's this trickle down effect, and obviously it affects all the borrowers, the economy, your job prospects, and all those kinds of things. It's important to note that a lot of times when the Federal Reserve has raised rates dramatically and quickly in order to combat inflation, like we've had big recessions, and not everyone, but a lot of people expected that we would create some kind of recession by raising interest rates so much. And that didn't really happen. Like job data is still really strong and things like that. So
Some
we're
people
in
thought the
pretty good
Fed
shape.
wanted us to go into a recession. Like that was kind of,
Yeah.
if you read between the lines, Jerome Powell's, talks in 2021, 2022, it's like without saying it, we need to go into a recession and people need to lose jobs in order to cool this inflation thing. Um,
Yeah.
they'll never admit to that, but
Yeah. I mean, it's kind of like the natural progression of things a lot of the time. But I think a little short history of the last couple of years would be helpful. So during COVID, the Federal Reserve lowered rates dramatically because we had such huge job loss, and like it was insane. Like obviously this was very unprecedented in terms of what was happening with the economy. And then also the federal government sent out a lot of money in the form of like economic stimulus. And then coming out of COVID, when we were like kind of coming out of that quarantine period, people spent a lot of money, like a lot of money, because they had extra money to spend. They'd been sitting on it because they couldn't do anything for like the longest time. Interest rates were super low. So it was just very easy for consumers to spend money, which led to like a lot of that inflation that happened. And then the Federal Reserve jumped in and started to raise rates repeatedly and quickly in order to cool that very, very high inflation. As inflation started to slow in 2023, the stock market also started to recover, just anticipating like, oh, inflation's getting better. Maybe interest rates will get better soon too. But it took a long time for that inflation to really get under control, and for it to be closer to what the Federal Reserve is targeting for like a target inflation rate. And that's like 2%. And right now it's still almost 3%. But they're looking at long-term trends, not necessarily what is the picture right this second. So they can start to think about reducing interest rates because inflation has trended so far in the right direction, or the direction that we were hoping it would. Um, yeah, I think it took a really long time for us to get to this point where we're thinking about having lower interest rates again. And it was just because that inflation was so sticky, even with really not really high interest rates, but much higher interest rates than we have had over the last decade or 15 years or whatever it's been. Um, it took a while for that inflation to kind of get under control. So we were the stock market at the beginning of the year was pricing in several rate cuts this year. I think like 5 or 6, right, Corey? Like towards the beginning of the year,
Yeah, I think about a year ago. So go back to late summer, early fall 2023.
2023.
I
Yeah.
recall, I want to say 6 rate cuts. I think the market
Yeah.
was anticipating about a 1.5% total by the end of 2024. Economic data at the end of 2023 came in stronger than expected, and then that was revised down, I think, to an anticipated 4 rate cuts for a total of 1%. First quarter of 2024, economic data came in strong. The Fed pushed out rate cuts, and there was some speculation, by early summer that we wouldn't see any rate cuts this year. But I think
Hmm.
it's funny because if you look at what was anticipated versus what actually happened, it's been wrong every single time, pretty much.
Yeah.
So as of this recording, August 21st, 2024, the market is pricing in 3 rate cuts of 25 basis points each, September, November, and December, I think it is, for a total of 0.75%. If I was a betting man, I would say it's not going to be that,
Probably not. Yeah.
even though it's highly likely that that could happen. It's also highly likely that it might be something different. It might total to 1%. It might only be a 0.5% cut. Who knows? But it's as of right now, I think when we had our meeting, what, a week ago, Cole said the market's pricing in 100% probability of a rate cut in September. So, I mean, that's a pretty high probability. Like, if you're a weatherman saying there's 100% chance of rain today, like, it better
It
freaking
better be
rain.
raining right now. Yeah.
Yeah. Like, so I think I mean, it's pretty likely. Like we said, inflation's come down, the Fed funds rate. There's no reason it should be more than 2% above the inflation rate. I think,
Hmm.
they'll probably cut it by a quarter point in September, see how things play out in October. And then after the election, probably do another small cut. But if, I mean, inflation jumps up, if companies go on a hiring spree and everyone starts getting pay raises in the next few months, I mean, I don't know what would cause that, but
Right.
then maybe they don't cut, or if something crazy happens where we go into a tailspin and they might do a bigger cut. I don't know. But yeah, I think it's probably a safe bet to say you'll see, give or take, 0.75% by year end, but wouldn't be surprised if it's not that. Um, because
Yeah.
it hasn't been as expected up to this point.
No, and we're just not good at being precise in our guesses about anything, right? So, and the stock market and the bond market are always trying to guess ahead of time what happens next, right? Like, and these are people making, like, retail investors are trying to do that to a certain extent, when you're buying and trading individual stocks. We're not great at it. The big companies are also not that great at it. So, when we're talking about like the stock market thinks this will happen, the stock market thinks this will happen, it's really like, the big investment banks and mutual fund managers and pension managers, like all those folks are the ones that have like the bigger impact on what the stock market is actually doing. But they're not right most of the time either. So we'll kind of see how this goes. Even though the stock market has been overly optimistic about all of the rate changes, the stock market has still done very well this year. I think that's very interesting as well. Even though like the stock market has repeatedly been proven wrong on the optimism about interest rate decreases. It's still going well. I don't
Well,
know.
it's not
It's really
just the
interesting.
stock market, it's the bond market too.
Yeah, yeah.
But I mean, at the end of the day, it comes down to fundamentals. Are companies making money, which is what drives
Hmm.
the stock market. Short term, it's anyone's guess. It's all about expectations. Did, this quarter you beat analyst expectations, blah, blah, blah. But I mean, all the publicly traded companies, they've been crushing it with their earnings. Like most of them are exceeding earnings expectations, um, which if companies are making money, it's good for their stock price. It's good for employees of those companies and non-publicly traded companies too. I mean, that's a lot of it with the inflation piece is people have jobs, people are getting raises, people are people, so they're going to spend money if they have it. If you spend more money, supply and demand, greater demand for things, companies are going to raise prices because they can, because people are willing to pay for it. I mean, this summer, like every day, record travel numbers, airlines are booked, hotels are booked, cruises are booked, try to go on a vacation somewhere. It's crazy expensive and crowded. restaurants, are packed. People are, restaurants are charging more because we're willing to pay for it. So it's, if
Hmm.
we're willing to pay for it until collectively as a society, we say this is too much, we're going to not pay for these things anymore. That's when you'll start to see maybe not prices come down, but
But
things
stabilize.
stabilize, inflation cools off. Companies might start doing uh, cuts to their workforce because they can't afford to employ as many people if they're not making as much money. And that's where the economy contracts and whatnot. But as long as people still have jobs and they're spending money, it's, companies are going to make money and therefore their stocks are probably going to go up over the long run. Short run, anyone's guess from month to month, but the longer time period you look at, the more likely it's going to rise in aggregate, at least, the stock market as a
Hmm.
whole.
Yep. I think longer term lower rates are expected to benefit smaller companies more because the smaller companies rely more heavily on debt than larger companies. So as rates start to come down, you'll start to see those small company stocks maybe do a little bit better. Um,
No
I
guarantees,
think,
of course.
yeah, exactly. Large cap stocks have done better than small cap stocks the past few years since rates increased. The S&P is basically at all-time highs again, repeatedly this year, while the Russell 2000, which measures like the smaller companies, needs to grow by about 15% to reach its all-time high from back in 2021. So, smaller companies have still really not recovered from 2022 as far as like stock price goes. Nobody knows what'll actually happen, obviously. And so it's really important to be well diversified as always. And what, we expect to happen is rarely what actually happens. We talked about this just now. Like, we can't predict that. Even the large investment banks can't predict that. Like even the big players at the table aren't necessarily good at predicting the future, are not good at predicting the future. Um, yeah, so I think we'll kind of see what happens. But I think there's a few things that we know affect consumers and that just the average folks walking around, which is like mortgages and housing costs and things like that. So we're going to switch to talking about that for a little bit.
Yeah. Beyond your
um
investments, how does this impact you guys?
exactly, I think mortgages are the biggest thing. A lot of people are assuming that mortgage rates will automatically go down if the Fed cuts the federal funds rate, but the Federal Reserve does not control mortgage interest rates. It's a free market dictated by supply and demand. We just talked about that a little bit too. They control like the overnight lending rate between banks. So when it is less costly for banks to borrow money, that means they don't need to charge quite as much to lend money. So it's a competitive environment. Like, how do we kind of walk that line between like how much can we afford to charge people, how much, all of that kind of stuff. It's also looking forward, just like the stock market and the bond markets are trying to look forward. So, according to Freddie Mac, mortgage rates have come down over 1% in the last 10 months. End of October of 23, the average interest rate for a 30-year mortgage was about 7.8%, and it was about 7% for a 15-year mortgage. And as of August 15th data, the 30-year rate is averaging around 6.5%, and the 15-year rate is averaging around 5.7%. So they're already coming down because they're already anticipating that the Federal Reserve is going to adjust the federal funds rate. So we're already seeing that. It's not like the Federal Reserve changes their rate and then mortgages adjust. They're already pricing in those adjustments.
Although the latter or former, whatever could happen where they change it after the fact if it's a surprise, but a lot of
Mm-hmm.
consumers, buyers, you and I are expecting rates to be lower. So why would we go buy a house now when we think in a few months we could get a mortgage for a lower rate? Well, the mortgage issuers aren't dumb. They want to get their business. They need to make their money. So in anticipation of that, it's like, all right, we think it's a safe bet that rates are going to come down. We could probably afford to reduce our mortgage rates now to attract buyers so that the buyers aren't waiting for a few months for that to actually happen.
Mm-hmm.
Um, and again, it's competitive. You got a lot of banks out there. They want the limited supply of customers. So if one bank's willing to undercut another bank, you'll see that uh, competition across the industry. So,
Yeah, that's why it's important to shop around. If you're looking for a new mortgage or if you're even like considering refinancing, which we'll talk about in a little bit too, like, don't just look at one bank, look at multiple banks and tell them that you're looking at more like multiple banks. And then, maybe there's more incentive for them to be competitive.
and
Um,
on the, if the market has already anticipated rate cuts, one could argue having rate cuts in the final quarter of this year, or I guess September was technically not the last quarter. Um, all that will do is just reinforce the expectations, and mortgages may not really change much between now and the end of the year. I think if rates are cut further than expected, then yeah, mortgage rates might decrease further. Or if it's expected that rates are going to fall even further, or Fed will cut rates even further in 2025, then yeah, maybe in anticipation of that, mortgage rates will continue to come down. But if rate cuts are less than expected, economic data is stronger, comes in, Fed says, yeah, we're not going to cut rates now, then maybe you might see mortgage rates come back up. It's a very fluid environment as expectations change with daily uh, the data changes daily, the expectations change daily as information changes and evolves. So like mortgage rates fluctuate throughout the day. It's not like here's today's rate, go out and buy a mortgage. No, they're constantly um, adjusting as new information comes in.
which is why a lot of times when you're like working on closing on a home, they offer like a rate lock, and why you have to pay for that because it's like fluid. It can change every day. But if you want that rate, like they may require that you pay a little extra money just to make sure that's the rate that you get. Yeah. We'll talk a little bit about this in a few minutes, but you could potentially consider refinancing a mortgage that you've secured over the last couple of years when rates were higher. Um, this is such not an exact science. It's a really hard one, honestly, to like walk the line on because rates will go down a little bit slowly. A lot of times it costs money to refinance. So if you do it too early, then you like paid all this money to lower your rate, but now you could do it again to lower your rate again, and then you have to pay for a refinance again, and it can be kind of a mess. So it's hard to time perfectly, but just make sure that you're really aware of all your options, and we'll talk about that again in a little bit. The other thing that lower mortgage rates may change is just housing costs themselves, like sale prices. So as rates decrease, it's really hard to predict exactly how that will play out. There's a potential for home sale prices to start to go up because maybe now there's more buyers that can afford a mortgage because the rates are a little bit lower. Um, but prices have still been increasing, even with rates really high. Like prices were up 5.9% in the United States from May of 2023 to May of 2024. And from April to April, they were up like 6.4%. So even with really high interest rates, mortgage like home prices have increased even so. And it's partially because inventory is really low. We have a lot of people who are sitting on homes with a really low interest rate and they don't want to sell that house because if they sell that house, now we've given up our 3% interest rate. And if we need to buy a new house, then, we have to finance that at whatever the current rate is, which is significantly higher than that, like 3% rate. So it's really hard to see how all these things will interact and play together because it's possible that as rates start to come down, more people that own homes currently will be willing to sell, but it's hard to know when that inflection point is. Like, when is it going to be like enough of an incentive for people to sell their homes so that they can buy that upgraded home? And it's also important to note that it dramatically varies from place to place. Like what's happening in San Francisco is not the same thing that's happening in Portland or Omaha. Like every market's going to be a little bit different.
Yep. Yeah,
Yep.
every market, every neighborhood, um, every individual, like your circumstances, what interest rate, if you're looking to buy a new house, get a bigger home, family's expanding, whatever, we're sitting on a 3% mortgage currently. All right, what's that comfort zone for you to where, all right, we can afford to buy a whatever $900,000 home at, is it 5%? Is it 6%? Is it 4.5%? Like, what's that comfortable interest rate zone for you? It's going to depend on your job, your income, etc. So
How much
case by,
equity you have in your house?
yeah, how desperately you want to get out of the house you're in.
Hmm.
So a lot, yeah, yeah, the equity, how much can you roll into the next one for a down payment? How much cash you have to put as a down payment if you don't want to, if you want to finance as little as possible. So a lot of variables there. The supply and demand thing, like you said, if interest rates come down, maybe more people are willing to sell their homes, which increases the supply. But you could argue the demand is also going to be increased because more
Right?
millennials sitting on the sidelines waiting to buy their first home. They've got some money now that if interest rates come down a little bit, they might jump on it. And so who knows? Very dynamic, hard to predict exactly. But
Hmm.
one thing, if you are sitting on a mortgage that you purchased in the last couple years and you do see an opportunity to possibly get a lower interest rate, I would start by asking your bank to do a rate adjustment rather than a refinance. And there might be a small fee for that, but if they can just adjust your existing loan to the going rate currently, that would be less of a headache, less costly for you than going through the trouble of refinancing, whether it be at the same bank or a new bank, same requirements. And it's also, if the bank knows you're going to refinance, and they know maybe there's another bank out there that's going to give you a more competitive rate than they're willing to offer. It's like, hey, we'll save you $4,000 in fees. And maybe your rate will be a quarter or a half a point more than what you potentially could get if you go shop around and go through the whole refinancing process, but you save time, energy, and money, depending on your circumstances, might not be worth the hassle for that extra quarter point of interest savings, depending on how expensive your mortgage is and how long you plan to stay in the home. So
Yeah.
that's the other component is it make sense to refinance? Well, it depends what the cost savings is, what that break even point is, how long you plan to be in this house. Like if you plan to move in a few years, probably not worth it to refinance right now. But if this is
Hmm.
the forever home, even a 0.5% difference might, make a decent dent in your mortgage payment over the long run. So who knows?
Yep. I think yields are another thing that we haven't talked about quite yet. Well, maybe you touched on it a tiny bit with bonds, but yields on your high interest savings account have been really high because interest rates have been really high. So that's probably going to come down. It's going to be like out of this honeymoon period with our high interest savings accounts. It'll still be much better than like your local brick and mortar bank, but it's just not going to be as high as it has been the last couple of years. CDs, like the certificates of deposit at your bank, longer term CD yields are now a little bit lower than the shorter term ones. So, like if you want to lock in that rate for 24 months, they're not going to give you quite as much because they know they're probably going to be lowering rates moving forward. And if they can do that sooner than later, it will save them a little bit of money. But you can lock it in for like 12 months and get like a pretty decent rate. Trying to do it longer, it's not going to be quite as good of a rate, which is it's okay. It's like, pluses and minuses to everything. With treasuries, kind of the same thing, shorter term durations currently have a higher yield than those longer term durations, unless you're looking at like a really long duration treasury bonds. But that, yeah, I mean, I don't know that a lot of people out there right now are messing around with that anyway, but good thing to keep in mind.
Yeah,
And
it's more of
then
like your bond portfolio.
exactly, like
But
mutual funds with bonds in them is really
exactly.
what you're looking at most of the time. Yeah. So the prices of those existing bond holdings in mutual funds could potentially like go up a little bit because they are holding some of those existing bonds with high yields. Um, so that can affect the bond market in general in ways that are like kind of hard to comprehend and understand, but it could be potentially a good thing.
And I don't follow the bond market super closely, but I would guess, I mean, the bond market is like a zillion times larger than the stock market. I'm exaggerating slightly, but there are so many more bonds out there in terms of volume and value than there are stocks. Um, so if you look at it, higher rates have only been present for the last couple of years. So, rates went up, rates come down. All right. So we have a small window where bonds are issued at more attractive interest rates. If rates start coming down, new bonds continue to get issued at lowering rates. You really only have a small sliver of the overall bonds outstanding that are going to be those higher rates. But, those are going to be more attractive than newer lower rate bonds. So yeah, those prices would rise, but I don't think it's drastically going to impact anyone, at least people listening here, anyone's portfolios. Um, yeah,
Well, especially because most of young listeners and things like that, they have, like 10% bonds in their portfolio. There's not a lot of, yeah,
Yeah, but
volume.
we need, rates sustained at a healthy level for an extended period of time, and then see rate decreases for those bond prices to really pop. That's where from the 80s to the late 2000s was a fantastic time for bond investors because we saw a 30-year timeline of declining interest rates, really like a 40-year timeline, and that continued to buoy prices of existing bonds over that period. And then we've since seen a reversal. Rates have come down, bond prices continue to drop. Um,
Mhm.
but the majority of your return from bonds is from the interest rate that they're paying. So long term, hopefully we'll have a healthy interest rate environment where there is some interest, maybe a little bit lower than today. And that's going to be good for investors as a whole because your bonds will actually give you some interest over the long run, which is really the objective of bonds anyways. You're buying it for the interest rate, not because you think
Mhm.
bond prices are going to go up or down. Like the range of returns for bonds from one year to the next is like single digits. It's not if you get a plus 10% return on a bond in a given year, that's like a phenomenal year for bonds as a whole.
And
Um,
probably not a good year for the stock market.
yeah, and negative 10 for bonds is like awful. So,
Yeah, absolutely.
so
Yep.
the bonds are the quote unquote safe things that don't change a whole lot in value. You get some interest and call it a day. Stocks are the things that go more like a roller coaster ride, but have more growth potential over the long run.
Hmm. So the big thing for everyone here is like, what should we do with this information? Right. So I think one thing for people to think about is if you have a lot of money set aside for like short-term savings goals in your high interest savings account or something like that, like, oh, I think in 2 years I want to buy a house or whatever it is, that might be a good time to consider certificates of deposit, knowing that those high yield savings account yields will likely go down. If we can lock in some interest for a little longer with a certificate of deposit, that can be a good idea. We don't usually suggest that people do that with their emergency reserves because we want that money to be very liquid. But any money that you've set aside specifically for short term goals, that could be a good thing to consider. I think with home purchases, this is always something we have to think about on a case by case basis. Like lowering interest rates will help and can make buying a home potentially more affordable. But it's also like you have to look at the details of buying and renting and your income and like how expensive homes are in the area that you live and always make a case by case decision based on specifics in your area and specifics of your own financial picture. I do think that talking to clients, it's hard because I think parents of people in our generation are very much like, this is what you do. You buy a house. But it's not always necessarily like the best or most desirable situation. So just make sure that you're considering those things very carefully.
But when you
Like,
tell parents
yeah,
that you're going to buy a house and then you tell them the price of the house and what your mortgage payment will be, they'll be like, you can't spend that much on a house. That's
yeah,
insane.
yeah. Like my mortgage payments. Okay, why is a house not affordable for you?
Yeah,
You're
you
a
need to
doctor,
spend $1,200 on your mortgage. It's like I can get a half of a studio apartment for $1,200 a month.
right?
That doesn't
Yeah,
exist anymore, mom and dad. You bought your home in the 70s for 40,000. Those don't exist.
yeah. Maybe that's what I should tell clients. Like, hey, run the mortgage numbers and then tell your mom and dad how much your mortgage payment would be per month, and then let them ask you like why you haven't bought a house. Like, hey, my mortgage payment is estimated at $10,000 per month. Yeah, that's why it's not affordable. Like, oh my gosh. Okay. Anyway, moving on. One thing to also consider doing, which Corey just mentioned, is asking your bank if you can do a rate adjustment without refinancing. It doesn't hurt to ask them if there would be a cost, what it would look like. Can they do that? Rates are lower. If they can't, maybe consider refinancing. But again, we've got to look at all the different factors of that. Like, what's the cost to do it? How much will your monthly payment be moving forward if I do it? How long will it take to kind of offset the cost of the refinance? Like, how many months of mortgage savings do I need for that to make sense? How long am I going to stay in this house? Are rates trending downward? Is it going to be like I refinance to save 1%, but like a year later, rates are down another percent? And now I want to refinance again because then I just wasted all that money to refinance the first time. And it's so hard to predict the future. We can't really. So you just have to make the most informed decision possible when we're thinking about those kinds of things.
I generally don't recommend adjustable rate mortgages for new buyers, but if you're in a healthy financial position, you have a relatively small mortgage balance, and your income's high, it could be a consideration. Go with an adjustable rate, knowing, all right, if I really wanted to, I could buckle down, pay this loan off in the next 5 to 10 years. We could gamble a little bit, take an adjustable rate with the high likelihood that rates are going to slowly start coming down here in the ensuing years. So not for everyone, definitely. And really for most people, it's probably not applicable because anyone who bought a house in the last year or two is probably not in a position to aggressively pay that off. Um, but and case by case, everyone's circumstances are different. So it
Yep.
might be
I
like if it's a
actually,
new house, I'm buying the vacation home. All right, I might be willing
uh-huh.
to go with the adjustable rate loan because I make a lot of money and um, it could be an opportunity.
Yep. I do have clients that have like a 7-year arm and that's their plan. They bought the house with a 7-year arm and they kind of want to like pay it off aggressively until it's done within potentially 7 years. I'm like, okay, let's slow our roll a little bit and think this through. But it's absolutely a possibility for some people.
And I'm sure there's some
Um,
loans out there that don't have the like the fixed rate period on the arm. Like you have a 7/1 arm, it's fixed for 7 years. Whereas I wonder if you could say to a bank, hey, I want a 0/1 arm. Like just go straight
mhm.
variable from the get-go. I'm sure there's some out there.
That'd be interesting. Yeah.
Yeah.
One thing is that if you do lower your mortgage payment, if you're able to do a rate adjustment, you're able to refinance however it is that you go about doing that, consider setting aside some of your monthly home ownership costs that are now reduced towards your long-term savings goals. Like there's a lot of people who have gotten into a home the last couple of years that really had to stretch to do it. And sometimes long-term savings suffers. And we have to save a little bit less because we really wanted to get into that home. And we spent quite a lot to do it. And it's been very costly. So if you are able to start reducing those monthly mortgage costs, think about putting that extra aside towards your retirement goals.
Smart.
Yeah, that's right. In conclusion, I think, the world's always changing and adjusting, and these macroeconomic things really can affect us financially, personally. Like there's some things we can't control and some things we shouldn't try to like change on a regular basis. I think one of those things is like the stock market. Like the stock market is changing all the time. We don't want to change our investments all the time. We want to kind of stick with those long-term plans. But things like interest rates can actually have a big impact on short-term decisions. Like it doesn't make sense to buy a house. Does it not make sense? Like what are we doing with our high yield savings? What are we doing with like our short-term goals? So this is one of those things where we look at how these interest rate changes affect our own personal finances and maybe even change our goals a little bit and reassess, like just with the new information that we have. And that's one reason that financial planning is kind of an ongoing process and not a set it and forget it thing, because things change over time and sometimes we make adjustments to make it all make sense again.
Well said. Thanks for listening. We'll see you next time.